you already know how to do. It's called depreciation, right? So depreciation, when you're determining the depreciation, you guys, you are going to, first of all, you are going to determine the components. Remember we talked about componentization? Now we have to determine what is the component, the depreciation for each of the components. So when you have, excuse me, I'm so sorry. When you have a building, and the building has a roof, it has obviously the elevator shaft, right? It has various different components. You can actually have different depreciation policy for each one. One could be double declining, one could be straight line. Windows, for example, right, is another separate component because windows usefulness and useful life will be different than, let's say, the roof and the bathrooms, etc. Let's say you own an apartment building, right? And your Cadillac Fairview. So that's often the case. So number one is you need to know what are different components. Number two, you need to determine the asset's depreciable amount. So what is that, you guys? It's going to be cost less residual value over useful life, okay? So you need, this is called depreciable amount. You need to know the period of the life of the asset, so 5 years, 10 years, 8 years, whatever it is. And you need to know the pattern. So this one here is all about straight line, units of production, or declining balance. Okay? So those are the four main questions when you're attempting to determine the depreciation. What are the components? What is the depreciable amount, which means you have to estimate the residual value. Okay? And what is the useful life? And what pattern of benefit, right, do you want to reflect the economic usefulness of the asset? Okay? So components, we talked about that already, you guys, right? So you need to depreciate each separate component. Depreciable amount is one that lets us, right, determine, okay, what is the residual value or salvage value. So let's break down the definition, okay? So for IFRS, it says that to determine the depreciation expense is going to be the cost minus residual value. What is residual value? Is the value that we're going to receive at the end of its useful life. Useful life is, right, is not the same as asset life. Okay? Useful life is how long does the company intend to use the equipment before it sells it, right? Before it sunsets it or sells it as a used equipment. Let's say we need trucks. Let's say we're UPS and we have like 100 trucks, okay? The cost would be the cost of the truck. The residual value would be the value that I'm gonna get for it at the end of the useful life. And the company would only wanna use the truck for 5 years. Why? Because they wanna flip it, they wanna buy another new truck. So they don't want a truck older than 5 years in the fleet. So the residual value is the value of what we can get for it for a 5-year-old truck. Does that make sense? Okay? Now, ASPE says we need to look at the greater of. Okay? It's going to be cost less residual value over useful life, same as IFRS, or it's called cost less salvage value divided by asset life. So what is salvage value, you guys? Salvage value is the value at the end of the asset's life. So for a truck, even though I'm only going to use it for 5 years, the truck's asset life is probably around 12 years. Okay? You could argue with me it's 15. You can argue with me that if it's a Honda truck, then it's going to be longer. Whatever it is, all the arguments are so valid, but the point is, it's going to be, right, the greater of these two numbers, the higher of the two numbers. Okay? Asset life is where the asset is at its last leg, that we're driving it to some sort of junkyard, right? And we're only going to sell it for parts. Okay? And the salvage value is what we can get for it at the end. Normally, it's like, you know, the parts to the car. Okay? So that's how you calculate depreciation. All right? So I've got some examples here, you guys, and I'm going to skip these examples because you're going to go through them yourselves. They're not difficult, and you can see that in this example, we can see that the IFRS depreciation is going to be, right, $800 per year. So we take the 10 less the residual value, that gives us 64 divided by how many years, okay? Whereas ASPE is the higher of these two numbers, and notice the 800 is the same as this one, and then the other one is, right, the expected life. Now, the reason why ASPE does this is because they don't want they don't want management to manipulate and say, oh, I'm gonna hold on to the asset until, you know, maybe I'm gonna hold on to it. I'm gonna change my mind later. But that's kind of where I'm going at. I want to play the game, the long game, to say which one's going to give me the lowest depreciation expense. Okay? Here they're saying, no, you can't play that game because we're going to calculate the two different depreciation. We're going to use the higher of the two numbers. Okay? So that's the ASPE. Obviously, when you start to choose the method of depreciation, you need to start thinking about things like economic factors, the obsolescence, the physical factors, the wear and tear, and the legal life. Okay? The choice clearly will affect the balance sheet and the income statement, so it's worth noting that, you guys. And if your statement is subject to ratios through bank covenants, and obviously it's going to be very important to be mindful of the impact to selecting the policy of depreciating the asset and what is the asset's useful life, etc. These are the methods that you know and love, so I'm not going to go through that with you guys. And this is an example that they have here. And again, I try to keep the example very similar to your textbook, right? Examples, so that you can bring that home a little bit and hone into that. Okay, and this is double declining. The word double means you multiply by 2. Okay, now how do I determine it's going to be 1 over the useful life? That gives us the declining model, and if it's double declining, you multiply by 2. Okay? And here, see the calculation, it's always book value, it's never, right, the depreciable amount, okay? Not depreciable amount. What's the difference here, you guys? It's that residual value. You don't include that in your calculation, okay? Because the depreciable amount is cost less residual value, right? That's what the definition is. Don't use that. Just use the cost or the net book value, okay? And this is what it looks like, okay, you guys? All right, so assets is not deducted. So I try my best to give you some examples that you can walk on your own, you can walk through on your own to kind of get that assessment, right? Again, another depreciation. The third one is called the activity method. This one, by far, right? So there's like a pro and con for this one, right? On one hand, this is the best one for matching principle, right? The more you use, the more depreciation you should be taking to match against the amount of revenue that you're generating. So the more you use, the more revenue you're gonna generate, and the more revenue you're gonna generate, the more expense you should be recording as well, okay? But the negative part about that, you guys, is that if you don't use it, because it's not really a good machine and you're not producing any units for sale, then you're not depreciating the asset. Unlike straight line, where you have to depreciate the asset every year, whether you use it or not, or the double declining, you're gonna depreciate the asset, but units of production is, the good part is it's good matching if you use it. The bad news is if you don't use it, you're not gonna depreciate the asset, right? Because it's based on the number of units produced. Natural resources, we talked about that, you guys. You're gonna take that 4 stages and you're either gonna use a successful effort method, remember? Or the full recovery method, those 2 options. Once you've established which 2 options to capitalize, then you're gonna deplete the natural resources, and that debit to depletion expense should be debited to inventory. And this gives us an example. So take a look at this example. You leased a land. Normally, mining companies, they lease it from the government, for example, or they lease it from, you know, right, from certain tribes, right? Particularly when you're up north. And then you add money to explore. Then once you know there's enough iron or coal, copper or you know, magnesium or diamonds or gold, whatever it is that you're mining, then you start developing it, and you can see development cost is the largest amount, okay, of the 4 stages. And then you got your 40,000, and of course you divide it by the number of ounces of gold, right? And by the way, where do you get this? This comes from the scientists, right? Usually a lot of these are reports from scientists. That's why your audit, right, course will tell you how do you rely on the specialist. So there are certain audit procedures as you're attempting to rely on the assumptions of the specialist. And that's how you calculate that, okay? All right. Now, partial year, obviously, if you bought the asset on January 1st, no, you bought it in April the 1st, then you're going to depreciate. The first year is only going to be for 9 months, because if you bought it on April 1st, right, April to December is 9 months, okay? So that's what it is, okay? So it would apply to this, it would apply to this, but not to this. Because naturally, if you use the asset starting April the 1st, the number of units that you produce for that first year will be naturally be less. Okay? All right. And this is some examples of that too as well. Again, you can follow the examples. A lot of the multiple choice questions I make up from these simple examples. Okay? Now, from time to time, you're gonna realize the asset is pretty darn good or not as good as I thought, so you're gonna revise your depreciation estimate. So the idea here is that when you think about residual value and useful life, there could be changes in subsequent years, right? Based on newfound information. This one you handle prospectively. Okay? So it says newfound information. That means that you didn't have that information in the beginning, and now as you use it, you realize, oh my gosh, this is really good, or holy smokes, it's actually not as productive as I thought it was going to be. Then that is prospective. But if you change because of information that was available back then, but you never considered it, that would be an error. So you got to go back and change. So that's the difference, you guys. You have to go back and retrospectively adjust, because it's not new information, you just didn't incorporate it in your decision making. So that was a mistake, okay? This is another example of revised depreciation, and the formula here, you guys, is this, okay? So when you're doing the revised depreciation expense, it's going to be equal to the carrying value of the asset prior to change plus any addition. So let's say we added a third floor of the building or something, or we added a new component to the equipment that makes it more productive. So we're going to look at the carrying value at the time before we did that change, then we're going to add the addition, then we're going to subtract. I call this the revised residual value. Revised means how much, right? And then we're going to take a look at the remaining useful life. So usually it's the original useful life plus any changes less how old the asset is. Okay? So if I did this 3 years later and the asset's useful life is 20, then it's going to be 17. Okay? Or if the asset at the end of 3 years we realize it wasn't 20, it should only be 14, then it's going to be 14 less 3 years old. Right? That's how you determine that. Okay? So that's the formula, you guys. And do you have to know this? The answer is yes. There might be some multiple choice question. Okay? All right. Now, this is where I want to get to, because this is something you are not familiar with. It's called the impairment test. Okay? And impairment test is where you've got to make the effort to assess whether the asset value, okay, has gone down. All right? So that's the impairment test. Okay? And it says it occurs when the carrying value of the long-lived asset is greater than the economic benefit. Economic benefit means the value, whether it's cash value or whether it's value in use. Okay? There are these indicators, and that often triggers the impairment. Okay? So how does it work, you guys? Under ASPE, it's only done when you believe something is not right. So what does it mean? So let's say you bought an equipment, $10 million, and it's used to produce, right, revenue A, B, and C. So let's say you produce a product that we call revenue A, B, and C. When you start to look at your cash flow, your forecast, you realize that no one's buying revenue A, B, and C. So that would be what I call an indicator. Okay? That would be called external indicator. All right? That means that the asset's not as good as you thought because it's not generating revenue either. Okay? Another way to look at it is you walk into your warehouse, you realize that that equipment is sitting idle because it's broken. Those are called internal indicators. Indicators mean these are things that you can see, that evidence that there's possibly impairment of that asset. Okay? So IFRS says you don't need an indicator, you got to do it every year. ASPE says all you need is indicators that triggers you to write off. That means ASPE, you're not required to do this test every year. Okay? There are two models, you guys. The ASPE is called the cost recovery model, and the IFRS, it's called the rational entity model. So let's take a look at each one. So these are indicators, you guys, right? So these are internal, external. I gave you some examples already. Externals are things like, I forgot to mention this one, legal, technological advancement. It could be like an environmental law that says you can't use this equipment because it's harming the environment, the ozone, level. So things like that, right? So that would be what government imposes. Those are external. Okay. Internal are obviously physical damages. You see them in the warehouse. You see that it's broken. Okay. Or there could be significant change in use, right? Right? There's no one's using this equipment. Okay. Or report that performance has worsened or increased in downtime, cost exceeds the expectation. So those are both internal and external indicators. ASPE says this: once you realize that there are these indicators that exist, you're going to start the testing. The testing first step is you want to compare the carrying amount against the undiscounted cash flow. Now, you know that an equipment will generate cash flow. And this is like the net cash flow, which means revenue less expenses. So let's pretend that the equipment that we're testing generates revenue A, right? Product A. Then we're going to look at product A's future cash flow every year. That will be sales every year, less their cost of goods sold, right? So that would be the amount of cash flow each year, and it's undiscounted. You're going to add them up. Now, in addition to that, if your cash flow only goes up to 5 years, how much can I sell that equipment for? So that would be the residual value at the end of 5 years, because that would be a cash flow amount, right? So what you're doing is you're saying, I'm going to look at the carrying value, net book value, and then compare that to cash flow for the next 5 years. I'm using 5 because anything greater than 5 would be a guess, right? And you can know this from finance, right? When you're looking at net present value of an equipment, right? Normally they say more than 5 years is often not, right? It's often very difficult to estimate the net cash flow after 5 years. And then you would also include in there the actual residual value. How much can I sell it for? How much cash am I gonna get that for the equipment? When you compare the two, if the carrying value is greater, then you need to do step 2. Step 2 is only if the carrying value is greater than the undiscounted cash flow. And by the way, if that's not the case, you stop the test. Even though there are indicators, you say, no, we're good. We can recover it through future cash flow. Then we're okay. The second step says, okay, we're in trouble. We know that there's a problem with this equipment. Then we're going to calculate the loss based on the carrying amount minus the fair value. Fair value means how much can I sell this equipment for today? It's called the quoted market price. Okay? Now it says, is it by its nature the present value or the discounted measure? So what they're saying is this, you guys. If I was to sell the equipment today, how much is it worth? That would be the fair value. If there's no market for that equipment, let's say the equipment was specialized, right? It was made specifically for product A or revenue A. And revenue A, right, is a machine that is specifically for revenue A. There's no market for it. Then it says we can actually look at the present value of those cash flow, right? Using some sort of imputed rate, normally the minimum borrowing rate, and that would be a substitute for the fair value. So go for fair value first. But if there's no market for that equipment, let's say it's a specialized equipment, right? Then present value the cash flow. And that will tell us how much the loss is. Now, can I reverse that loss, you guys? The answer is no, you cannot. ASPE says once you write it down, you're not going to reverse. Now, once you write it down, you guys, you are going to recalc depreciation expense based on new assumptions on useful life and residual value. So clearly, what we're gonna need to do is, once we write it down, you're gonna recast the depreciation, right? Because obviously the asset wasn't as good as you thought, okay? And it's gonna result in, uh-oh, did I not plug it in, you guys? Uh-oh, we cannot have a power failure. Yay, it's saved. Imagine what would happen, okay? Right? And then it's gonna result in deferred taxes, right? Now, you don't know deferred taxes at all, you guys. That's gonna be ac02. And it's gonna change the deferred tax balance on this asset. Okay? So that's all you have to know for ASPE. IFRS, oh, sorry, this is like an example of it. So you can take a look at what I just, the example here. Okay? The IFRS does it a little bit differently. It's called a rational entity model. The first thing is you must, right, test impairment every year, okay? So number one is testing must be done each year. Okay? And what you're gonna do, you guys, is you're gonna calculate this thing called recoverable amount. Recoverable amount is the greater of two numbers. The greater of two numbers, the higher of the two numbers. The first number called value in use. And value in use is basically the fancy word for discounted cash flow. So remember, if I'm gonna use this equipment, this is how much cash flow I'm gonna get, plus the sale of that equipment, I'm gonna discount that to today's value. Okay? Then I'm gonna compare that to how much I can sell it for in the marketplace today. Because a rational person would choose the greater of the two. If I'm only gonna get $100 million of future cash flow, present value today by using the asset, but if I was to sell it today, I get 120 million, why would I not sell it today? I'm making an extra 20 million. A rational person would say, I'm gonna choose the higher of the two. That's why it's called the rational entity model. Once I find the higher of the two, the loss will be the difference between the two. Okay? So the loss will be the difference between the two. So you would then write it down. Okay? Now, this will result in a change in depreciation expense. Why? Because you're going to change residual value and useful life, and then it will also change in deferred taxes. Keep that in mind when you take CO2, okay, you guys? And can impairment be reversed? The answer is yes, but only up to the pre-loss carrying value. What does that mean, you guys? So let's say year 2, we realized this was a bad investment, right? We bought an asset that we thought was going to be amazing. It wasn't as good as we thought. We wrote it down because the recoverable amount is less. All right, that was year 2. We're going to change the depreciation expense, right? Because it's going to have a different useful life now. Do you agree? Okay. Year 5. Fast forward to year 5. We now did this test again, and we realized, oh my gosh, this is really good. The equipment is actually better. So is it possible that maybe this equipment is so specialized that it's creating a product that has increased its demand? So let's think about a product that wasn't really great, and now all of a sudden everybody wants to buy one. That's the kind of idea here, right? So, this is year 5. We wrote it down in year 2. Now we've got the scenario where the recovery amount is higher. Now, how much can I write up? Is it the original loss? No, you can't. What we're gonna have to do is we're gonna say, what is the net book value of this equipment had we not written off in year 2? So what's that carrying value at the end of 5 years had we not written it down in year 2? That is the most I can write up, right? The most I can write up is what they call the pre-loss carrying value. Pre-loss means without the loss, what's the carrying value? Okay? That's the amount that we can write up. It's only IFRS that you can write up. ASPE says no. Once you write it down, it stays down. I don't care if the equipment is all of a sudden, right, better, or the revenue that we produce in equipment is now has an increased demand. I don't care. Write it down, it stays down. IFRS, you can write up to the pre-loss carrying value. Okay? And this is the example, you guys. This is called a rational, because a rational person would pick the greater of the two to determine whether I should keep the asset or not. Okay? All right. Now, one last thing in 1 minute. I talked about an equipment. An equipment in itself does not generate cash flow. It's going to be a group of equipment. Remember, right? When you're doing this test, it's meant to be done at the group level, because not one asset, one equipment generates cash flow. It's going to be a group of equipment, correct? So the idea here is we're testing it based on a group level. So in the supplemental problems that I'm going to do, there are these questions about impairment loss. And you'll see that we're going to do them in group level. And when you do it in group, the thing that you need to realize, right, is when we calculate the loss, we're going to allocate that loss to each individual groups of asset. So let's say there's 3 groups that generates the cash flow, and we did this test, and we say, okay, we have $1 million of write down, then we're gonna prorate it. We're gonna allocate that 1 million against the 3 different assets, okay? Now, there's one caveat. When you do that, and one of them is written down lower than its fair value, then you can't do that. You gotta only write it up to the fair value. That means that, remember, there are 3 assets, right? If one of them, if let's say we have $1 million loss and we prorate it, right, you guys? Then when we have the new carrying amount, the value, and let's say asset A, right, we wrote it down to 38 million, the fair value is actually 40 million. You can't write it down below fair value. So now we're gonna plug the number, okay? So that asset A can only go up to 40 million, and the difference in the remaining loss is allocated on the remaining asset B and C. So you'll see me do that in a supplemental problem, and that's exactly what our standard says, okay? I think I have it in my notes here. Yeah, right here. No individual asset should be reduced below its fair value, okay, if these amounts are known. So that's what you're gonna see me show. That's where you're gonna see me do that. Okay? All right, now, asset held for sale, we already saw this prior to the midterm. These are obviously assets that we know we are discontinuing. Remember, this is part of the discontinued operation. Remember that, you guys? We have a discontinued loss. And if we have the asset still held for discontinued, but we haven't sold it yet, you can only write it down, but you can't write it up. And that's what this is, okay? So that's another area there. Derecognition is basically saying, hey, I want to be able to dispose of it because it's no longer good, or it's gone, or it's damaged, and the gain or loss goes to other income. Okay? So that is chapter 11. 11's not hard. You just have to go through those examples. The hardest part in these impairment tests, and we're gonna do some more problems in that one under the supplemental problems, okay? Now, we've only got one more week left of classes, you guys, you know that, right? Okay, next week we're gonna deal with chapter 12, and that one we're gonna deal with intangible assets and goodwill. And there's another impairment test there too. This time it's gonna be on intangible asset and goodwill. Okay? All right, thank you. Have a great day.